If you worked overtime in 2025, you may be owed a tax refund in 2026, but only if you understand one very important thing. The overtime tax break is real, but it's not as big as the headline suggests, and it's not automatic. Today I'm going to show you a bunch of things. Number one, exactly how the overtime is actually tax-free. Two, when the phase-outs apply. Three, how this works differently for hourly individuals versus salaried employees. Four, how you figure this out using nothing more than your pay stubs. And most importantly, five, how to calculate your refund. And I'm going to do it with real numbers. So let's start by clearing up the biggest misunderstanding. When people hear no tax on overtime, they assume their entire overtime paycheck is tax-free, and that's not true. First off, let's go over some of the rules. If you are single versus if you are married filing jointly, this is important. If you're married filing separately, you don't get this. So it's single or married filing jointly, and here's the limits. You get a deduction if you are single of up to $12,500 that you get to deduct above the line. Like, you don't have to worry about doing your itemizing. I'll go over that again, but you don't have to worry about this. Number two, if you're married filing jointly, it's $25,000. Those are the deductions. This means that it is a deduction for qualified overtime compensation for the year. It is, like I said, above the line deduction, meaning you don't have to itemize. If you make $60,000 and you have $5,000 in qualified overtime pay, your adjusted gross income becomes $55,000. Secondly, there are phase-outs, and this is based off your modified adjusted gross income. That's going to be really important here in a second, but let me go over what these are. If you are single, you start to phase out at $150,000. If you're married, filing jointly, double it. It's $300,000. And this is your modified adjusted gross income, meaning you can actually lower it by contributing to a 401k, HSA, health savings account, your IRAs. Like, you can lower it to make sure that you qualify. For every $1,000 above those lines, you lose $100 of the deduction. Third, only the overtime premium qualifies, not the base pay, not your entire overtime check. And this is also important. If you make tips while working overtime, you don't get to count that either. So if you remember nothing else from the video, remember this. The deduction applies only to the extra pay above your normal hourly rate. And here's the formula, and this is the entire rule in one line. Your overtime deduction equals your overtime pay minus regular pay. Let me just say that. Your deduction is equal to your overtime pay minus your base pay. And don't worry, I'm going to give you a bunch of examples. Whatever you have earned at the normal base pay, at your normal amount, is still taxable. Only the extra amount on top is eligible. So let's make this real. So I'm going to give you an example. Let's just say you're an hourly worker making $100,000 or less. Let's start with the easiest case, and that is you're an hourly employee. And let's just say you make $30 an hour. Okay, that's your base pay. Your overtime rate is 1.5. So let's say every time you work overtime, you're getting $45 an hour overtime. Okay, so over the course of 2025, let's assume that you worked 400 overtime hours. So 400 hours, and I'll say overtime, 2025. Make sure we don't cross over there, right? All right, so let's just say your total income for the year is $95,000. So step one is to split the base pay from your overtime premium. So the base pay portion, we'll just do the math here, is 400 hours times $30 an hour, which is going to get us to, what is that, $12,000. All right, that's fully taxable. Your overtime premium is the extra $15 an hour times that 400 hours. So we already know, here's our overtime. When we take our overtime pay minus our base, so remember, overtime pay minus base pay. Overtime pay is 45 minus 30 equals 15. We multiply that times 400 hours. What does that get us? $6,000. So that's our $6,000. That's the $6,000 is the only amount that qualifies, not the full $18,000 that were made in your overtime. So if you looked at your overtime pay on your pay stub, you might see $18,000. That is not what the deduction is. You have to remove the base pay from it. It is only the premium. Step two, let's make sure that we didn't phase out. Remember what our phase outs are. So I'm just going to type, I'll write in phase outs. Right? We have 150,000 or 300,000. So in this case, this was a single filer making less than 100,000 bucks. They're well below the $150,000. So the overtime deduction doesn't even begin phasing out until you hit 150,000. So they make $95,000 in our example. So there is no phase out. So you get the full $6,000 deduction. Boom. What does that mean in real dollars for your refund? Well, you have to look at what your withholding rate is. Generally, it's going to be 22 to 24%, right? But again, so if you're in the 22% withholding rate, then you would multiply $6,000 times 0.22, and that's going to get you, so 22%, and you're going to get $1,320. That is the amount of money that was already withheld during the year. So when you file, you're going to get it back as a refund. Now, obviously, you do this on your entire tax return, but that's the amount that you could say, hey, what did I get from the one big beautiful bills, no tax and overtime? That's what you're going to end up getting, is about an extra $1,300. Not a small amount. Like that's good. Now, how do I find this on my pay stub? Well, I say this is the easy part. I wish it was really that, because report from your employers, they don't actually have to report this stuff until 2026, so next year. So this year we're in the gray area for 2025, which is our tax year 2025. So I'm standing here in 2026, we're looking at doing our 2025 tax return, and your employer may not break it out. So you're going to have to look at your regular hours, you're going to have to look at your overtime hours, you're going to have to look for your overtime rate, and your pay stub should have all this broken out. And then you could do the numbers I just showed you. You could break it down and say, all right, here's what I can figure out. What was my base? What was my overtime pay? If it's 1.5, it's easy. When you're hourly, it's really easy to figure that out. It gets to be a little bit of a nuisance when you're salaried. So let's make that our second example. Let's say you're a salaried employee, single again, making $150,000 a year. And since we're talking about salaried workers, this is the part where most people are going to get confused, right? So let's say that you're single, you're salaried, you make $150,000. Now the question is, are you an exempt employee or non-exempt? You're going to have to ask your employer. But if you're non-exempt, then you're legally eligible for overtime. If you're exempt, it means you don't get overtime. You will know this by looking at your pay stub and talking to your employer or HR. But let's assume that you're eligible for overtime. So here's the key rule. For salaried overtime calculation, the law assumes that you're working 52 weeks per year at 40 hours per week, which that means it equals 2,080 hours per year. So our first step is to convert our salary into hourly, right? So we have $150,000. I'll write it over here so we can kind of see it, make sure I don't go off the board here. $150,000, we have to divide it by the total hours in the year. So remember, we had the 40 hours a week, 52 hours. So we have 2,080 hours. So that is equal to $72 per hour. Here, I'll put that around it. $72 an hour. Scribbling all over the chalkboard, I apologize. Now, let's assume that your overtime rate is 1.5 times that. Some of you guys are double. But let's just say 1.5 times that. What is that going to equal? That's going to get us to $108 an hour for our overtime pay. So now, how do we identify the premium? You guys already know how to do this now. The overtime premium is the difference. It's $108 minus $72 an hour. And that's going to get us to $36 per hour. That's the overtime, I'll just call it the overtime premium. All right, so let's say that you worked 200 overtime hours in 2025. So we had 200 times 36, which is going to get us to $7,200, $7,200 of the qualified amount of that overtime deduction. And so this is the amount that is you're potentially eligible for. And then we go back and we look at phase-outs, right? So here's the problem. In my example, I'm giving you right at $150,000. So you're right at the line, which means you get the deduction. This means the deduction will, if it goes above 150, might be partially reduced or eliminated, depending on what your final adjusted gross income is. And this is where planning matters, right? So if you have maxed out your 401k, if you fund an HSA, you may be able to push yourself below a threshold and preserve the deduction. And most people miss that entirely. But in this case, it was $150,000. So did we phase out? No, we're right on the line, which means we get our entire qualified overtime deduction. And so then we take our withholding rate. So again, let's assume, I'm going to use in my example, it's 22%. Again, your situation may be a little differently. So you're going to end up with a total tax benefit, dollars in your pocket, of $1,584. That's how you do it. All right. Now I've been doing the singles. Let's do a married couple. So let's say you're married filing jointly. One spouse earns $75,000. The second spouse earns $200,000. So not too uncommon, right? So the total household income is $275,000. Spouse one works overtime and has $8,000 of overtime premium, right? So we do the calculation and they have $8,000. Are we worried about the phase out? Let's look over here. Married filing jointly. I just told you they made $275,000 a year. Are they phased out? No. This couple is below that threshold. So even if one spouse makes over $200,000, right? But the couple still qualifies, and they would get the full $8,000 deduction. Now, these folks are making a little more money. So let's say that they're doing a little more withholding, and they're in the 24% bracket. So in this case, they have an $8,000 overtime deduction. Let's multiply it. Let's say they're withholding 24%. Again, your numbers will be whatever your numbers are, but you're going to multiply whatever that amount is times whatever your withholding rate is. So in this particular case, that would give us $1,920 of savings. Again, this is usually refunded because your withholding was not adjusted. Now, time out here just quickly. This is federal tax, income tax. It is not your employment tax. It is not your state taxes, unless your state conforms. So this is your federal income tax. So this is why you're calculating it as a deduction on your tax return. It may or may not get you anything back on the state. And then for employment taxes, so your Social Security and your Medicare, it will not impact that. Now let's go back to hourly versus salary, because there's some big differences. So hourly workers, it's really easy. Overtime is clearly shown on your stub. Like, it's always going to say, here's how much I got for this, here's how much I got for that. So if you know your base pay, it's easy. And this is where it gets tricky, is if you move during the year. But generally, that premium is easy to calculate, and it's not a ton of ambiguity. With salaried workers, the first thing you have to answer is, am I exempt or non-exempt? If you're exempt, you don't get anything. If you're non-exempt, you're getting overtime. But you must convert your salary by using the 2,080 hours test. And you'll often need to get a payroll or an HR confirmation on what these things are. Salary alone does not eliminate overtime eligibility. Exempt status does. Now, let's go over what most people miss. So here are the big traps. I've already hit them, but I want to make sure you understand exactly what I'm saying. Not all extra pay is overtime. Bonuses, shift differentials don't qualify. When you're looking at overtime pay, it's like time and a half and double time are generally qualified, but it's only the premium amount, the difference between your base and that amount, not the entire amount. So only the amount above the base pay counts. So if you remember, overtime pay minus base pay. Your W-2 may not break this out for 2025. They do, your employer does have to start doing so for year 2026, so next year. But for 2025, you're going to have to calculate this yourself. And remember, this only affects your federal income tax. Social Security, Medicare, and most state taxes will still apply. So here's the takeaway. The overtime tax break is real, but it's narrower than the headlines suggest. So if you understand overtime premium, the phase-outs, and how your pay structures work, you can still put real money back in your pocket. That deduction is above the line. By the way, guys, if you like breakdowns like this, make sure you subscribe, and please like the video. It really helps our algorithm. And if you have any questions or comments, just put them in the comment section below, please. And share this video with whoever you think will benefit.